You are listening to chartingwealth.com for Tuesday, the 9th of February 2015. We always start with IYY, which is a total market fund. It's an ETF, an exchange traded fund that tracks the whole market. And what we see happening in the market on our 2-day chart is a big down candle. Actually, the down movement is shown by the bottom wick on this candle is about 1.5 times the actual down movement. The prior candle showed a lot of indecision, what we call a doji. Looks like a cross, means there was as much pull up as there was push down, so the market opened and closed about the same place. That always means indecision, and of course it was followed by a reversal of an up move and then a big strong down move of the last 2-day candle. When we look at our 4-hour chart, we actually see massive movement starting in the morning on Monday rather, and followed by more movement in the afternoon. The total market was actually down 1.44%. And that's a pretty strong down market for a day. That was a total market. Now, we know that down move that started around the 5th, the morning of the 5th, actually was a reversal of a short-term uptrend, and then this down move paralleled the down market. The market had been moving down since the beginning of the year. That is typically a good time to get in and buy the down move. You might say, how do you buy the down move? Well, you buy an inverse fund is one simple way to do it. There are many other ways, but typically the easiest way is to buy an inverse fund. And of course, hopefully, those of you who take our advice have gone out there and opened up a virtual account at any of the online brokerage houses, did just that. And or did it in either IYY, did it in the total market, or even easier in SPY or the Qs, and we're going to talk about those in just a minute. So we're going to range out to our 2-day chart. We're then going to go to SPY. It was down 1.35%. Total market was down 1.44%. It looks somewhat similar to the total market, a doji in the last candle on the 4th, and then the candle that ended on the 8th was actually down strong, and the down movement was even stronger, all the way down about 1.5 times the closing movement on that candle. Means that as much as the bears were able to drag it down, the bulls were able to push it back up to stop some of that slide. But that slide resulted in a short chart that rolled over again around the 5th in the morning. The trade would have been sometime in the afternoon, and of course it was followed by a lot of down movement on Monday in the markets. Now again, that paralleling the down move, the market had rolled over and it actually had rolled up and then rolled over starting on the 5th. That is the time where you get into the down move. Now let's go to the Qs at this point, and we'll also take a look at our 2-day chart with the Qs. The Qs was down strongly, 1.53. This chart looks a little different than the IYY, this total market, in the S&P 500 as shown to you by SPY. The Qs is the NASDAQ 100. It rolled over going down on the 2-day chart on the 4th of December, moved down strong throughout. Well, it moved down strong to begin with, then slid sideways for a while, and at the beginning of the year started down very strongly. Around the 25th or so of January, it started to tick up. It really did not a whole lot more than sliding sideways. Then it rolled back over again strong, starting on the candle on the 4th rather, and then followed on with the down movement on the 8th. Now, let's look at, and again, please note that the market rolled over back at the end of December, beginning of end of November, beginning of December, and it has been in a down move. And what we always want to try to find when the market's in a down move is where it rolls up, as the market started doing on the 21st of January, and then where it rolls back over. And that back over turn happened right around the 4th of February, and that would have been the entry point. And you, even if you had bought in at the worst time, sometime in the afternoon of the 4th of February, that was a Thursday, if you'd gotten in at the worst time, the biggest low was 100. Where was the market when it closed after the market closed on Monday? $96. Now you might say, wait a minute, how do I make money when the market goes down? Well, as I said earlier, an inverse fund. There's something called QID, which is that's its designator, its symbol. It actually is a double inverse fund, which means when the Qs goes down, this fund goes up twice as much as it goes down. I would encourage you, you can find several of those that you feel comfortable with, both an inverse of the SPY, an inverse of the total market, even an inverse of gold, and of course, I've just told you one with the Qs, the NASDAQ 100. So take a look at those, and when you see possible trades happening, do your virtual trade. Do a virtual trade in the inverse and see if it actually makes money for you. You would have done quite well here. You might have done as much as $7 or $8 up over just the last few days. And again, this is one of the easiest techniques there is. When the market rolls in one direction on the big chart, you wait for a pullback on the smaller chart, whether it's moving up in a down move or moving down in an up move. And then when it reverses and starts going in the direction of the big chart, for us it's the 2-day chart. So when that 4-day chart rolls over, that's the time you get in. That's when you, many times, can get in the safest. So experiment, try. That's what a virtual trading account is all about. See if you can make money. Once you get good at that, get good at reading the charts, get good at following the indexes that we follow in gold, then you can start considering what you might want to do with your own money. But again, we're not a stock calling service, we're an education firm. But please, try this, work on it, listen to us every day, practice. And remember, it's not practice that makes perfect, it's perfect practice that makes perfect. That's what you got to work on doing, is perfecting these techniques, perfecting your knowledge. Okay, lastly, we're going to range out to the 2-day chart one more time. We're going to look at gold. What has gold been doing? Well, gold has been an up move since back in December, around the 16th. It rolled over, going up. Now, it really slid sideways as far as the price movement went. Then it started ticking up around the 5th of January, and it rolled up for 3 candles, so that was 6 days, then over a little bit, and then is when it really took its climb, starting right around the 19th to 21st. It really started rocketing up, and this last candle is amazing how much gold has gone up. If you would have gotten in, well, we're going to show that in just a minute, but you would not have wanted to jump in right here because there wasn't a signal to jump in right there. And when I say there, for those of you listening, around the 14th of December. But if I go back to the 4-hour chart and we take a look at when the 4-hour chart rotated over, it rotated over going up around, and remember, we weren't all that happy with the 4-hour chart back in December because it really slid sideways on us so long. The MACD is not a good indicator. That's the moving average convergence divergence. It's the big indicator we use at the bottom of our screen. If you don't have our layout, you can get it by simply signing up for our daily podcast. You can do that at chartingwealth.com. You sign up for it, we'll send it to you every day, along with a link to our charting layout and a link to our How to Read a Stock Chart video. So there's a crossover going up on the 20th, and what basically happened right then, there was a little bit of an uptick. Then the market slid sideways until about the 25th of January, and then the market started moving up and has moved up significantly, particularly as February took off. Gold just started climbing like crazy. It ended the day on Monday up 1.34%. So if you'd have gotten in sometime around the 20th, at the highest peak it hit, which was 106.16, it's now 114.16. That's where the market settled out at the end of the day. Pretty amazing stuff. Pretty amazing climbs. So that actually, I'm sorry, I'm looking at a chart now. I'm looking over here at what actually happened. Gold ended up at 113. 83. So again, not quite 114, but amazing climbs. And again, how do you do this? Well, you wait for the charts to move in one direction on the big chart, then the small chart roll back in the opposite direction, then move back in the direction of the big move, and that's when you get in. Does that happen with every move? No, it does not. So does that mean you trade all the time? No, you don't trade all the time. You wait. That's the beautiful thing about being a part-time investor, trader, somebody who follows the markets. You're not like a professional trader. You don't have to trade all the time. You trade only when the getting's good. And that is what we try to instill in you and teach you here. So please try all this, experiment, open a virtual trading account, see what works for you, take what works, discard what doesn't, modify it, become your own investor with your own train of thought. We're not here to create robots. We're here to teach you, to have you gain knowledge and skills, and then use those when you feel comfortable with your own money. Thank you so much for listening. We appreciate you being part of the team here at Charting Wealth. If you have questions, concerns, problems, address us on Facebook, Twitter, Instagram, YouTube. You can write us at the website, chartingwealth.com. Sign up for our daily newsletter. You also, once a week, go get our weekly review and forecast. We love to hear from you. God bless. Wish you the best in gaining knowledge and how to invest and trade. From chartingwealth.com.